Hello from all of us here at Robare Jones. Wanted to take a little bit of time and give you a quick update as to the rebalance that's coming up in the next couple of days. Biggest change that we're going to be making is we're removing most of our overweights to the value side of the portfolio on equities. And reason for that being is that we held it in 2022 and it paid off, and now it's time to move to greener pastures. So replacing that, we're going to be using quality as a kind of a filter. And rather than focusing on just value itself, we're looking at companies with very strong balance sheets, very resilient, regardless of the economic environment, and just have a long history of profitability and consistency. So you'll see that piece replaced, a big portion of the value piece at least replaced with a quality factor that's really focusing in on those type of companies within the domestic equity portfolio. On top of that, we're going to be unloading further a little bit more from a just kind of a blanket S&P 500 value position that we have. We're going to be replacing that with just a technology or a growth-centered position. So really on the equity side of things, the biggest change, notwithstanding the value to growth shift, it's going to result in basically more of a blended equity allocation rather than an equity or either a growth or a value overweight. On top of that, we're going to be expanding our exposure to developed international markets and increasing a small portion of, or a small exposure to emerging markets, excluding Chinese markets. On the fixed income side of the portfolio, we are aiming to increase duration, increase credit quality, all at a time where interest rates are maybe not at their peak, but we have good indications that we're not going to see a repeat of 2022. And typically, as we know, when things are good, interest rates tend to stay the same. When things are getting a little too hot, they tend to rise. So that's, to fight the inflation. And then when things get bad, they tend to fall. So we think that it's more likely that we're going to see interest rates kind of stabilize. And if there is a equity market shock or a recession coming, then we would expect interest rates to fall, both of which argue for a longer duration bond portfolio. The good news is bonds have kind of normalized to some extent, especially in comparison to what we saw in 2022, where the relationship between equities and bonds that had historically been in place that was non-existent last year is now back in season, so to speak. So our bonds would actually act as a hedge, so we don't need the option-based hedge strategy that we had in our defined risk position. So that will be unloaded. Commodities as well. We are not expecting a long-term kind of high inflation period of time. So our commodity position, which we've held for over a year now, is going to be sold. On top of that, we're really taking all the opportunities on the taxable side of things to harvest as much loss as possible and replace those with very similar positions if we are making a lateral move, or replacing them with new positions if we're changing overall overweights, growth versus value as an example. You'll notice that our internal cost of the portfolio, I'm happy to report, will be coming down by about 10 basis points. So going from an average of about 18.18% down to 0.08% in the overall average portfolio internal cost. If you have any questions or if you would like to schedule a meeting, please don't hesitate to reach out to us. Have a great day and look forward to seeing you soon.